Hello, Angela Owens with Phenomenal Business Solutions, and I help businesses streamline their finances, grow their profits, and grow their businesses. Today, I want to share with you some information about taxes. We're just going to cover a lot of the basic information so that you will understand different terms and how taxes affects you. So first, we want to recognize the difference between credits and deductions. So credits reduce your taxes, and when you're spending money, that typically does not have an impact on your credit. There are some exceptions, but for the most part, if you're spending money, that's not really going to help you with the credit. And some credits are refundable and some are not refundable. So deductions, they actually reduce your taxable income. So the amount of money that you make is taxed, and so with the deduction, it's going to help you reduce the income. And it's typically based on money that is paid out through the year, like hospital bills and taxes and different things like that. And you can choose between standard or itemized deduction. So, like I said, you could choose between standard or itemized deductions. So with a standard deduction, it's just a flat amount that lowers your taxable income so that you can only pay taxes on what's left. So for 2024, single, married, filing separately, you get to deduct $14,600. Head of household is $21,900, and married filing jointly is $29,200. So some people, when they get married, they're concerned about whether they should be filing single or if they should file married filing jointly. But as you can see, with the standard deduction amounts, you benefit better by filing jointly, especially depending on how much the joint income is. And then you have the option to do itemized deductions. So you're gonna be able to deduct your mortgage interest, your real estate tax, medical expenses if they and the medical expenses you can only deduct anything more than 7.5% of your adjusted gross income. You could actually deduct your sales tax if you live in a state that just does sales tax. You can have a standard sales tax deduction. And then you can also deduct your charitable miles. Like even if you volunteer at church, you can deduct the mileage that it takes you to get to church for your volunteer work. And you can also deduct casualty and theft losses. So once upon a time, mortgage interest used to help a lot of people be able to lower the income. But with the standard deduction being so high, a lot of people are not paying that much in mortgage interest or real estate tax. So it's more beneficial to just take the standard deduction. So when you get ready to get your taxes done, just look at your mortgage interest sheet and see if you paid more than the standard deduction, and that will let you know if the mortgage interest is going to help you on your tax return. And we want to talk about the refundable versus non-refundable credit. So we have the earned income tax credit is refundable, as well as the child tax credit, the American Opportunity Tax Credit, and the premium tax credit. So the child tax credit is partially refundable. So what that means is the most that you can get for the child tax credit is $2,000. But the most that's refundable is going to be 1,700. So refundable is anything that goes over your taxes due. So you can reduce your taxes by $2,000, and that will be when you're getting the whole $2,000 credit. But then only 1,700 of it will be refundable if you don't have any taxes due. And same with the American Opportunity Tax Credit. The maximum is $2,500 that you can reduce your tax bill, but only $1,000 of it is refundable if it goes over the amount that you owe in taxes. And then the non-refundable tax credit is child and dependent care credit, savers credit, clean vehicle credit, residential clean energy credit, and lifetime learning credit. So again, these non-refundable credits will reduce your tax bill, like how much you owe. So if you owe $2,000 and you paid $7,000 in child and dependent, care, you'll only get the $2,000 off because it'll bring you down to zero. So any of these non-refundable credits, it's just however much will bring you down to zero, and then that's it. So you won't get anything refundable on that. So these are deductions that you can take on top of the standard deduction. So the teacher's expenses, you can max out at $300. If you paid in student loan interest, you can max at $2,500. And there's some times you can claim non-reimbursable employee expenses if you are armed service, reservist, qualified performing artist, fee-basis state and local government employees, employees with impairments related to work expenses, and then for military, you can deduct some of your moving expenses. And this will be on top of those standard deductions that I had mentioned on the other slide, and that will reduce your taxable income. So if you file a married filing separate, you need to understand that both of you must take the same deduction type. So if one of you does itemized, both of you have to. If one of you does standard, both of you have to. In community property states, both incomes have to be included. And you also lose opportunity to claim certain credits like the earned income tax credit, adoption tax credit for the elderly and disabled, child and dependent care, education, student loans, and tuition and fees deduction. Some people try to choose this option because they want to avoid incurring their spouse's tax liability. But instead of married filing separately, you can file something called an injured spouse. You can file as an injured spouse. And what that does is that will take away your responsibility of being liable for their tax liability. So check and see if injured spouse might be a better option for you than filing separately so that you can still take advantage of the credits without being hurt too bad on the refund. So if you have a business and you claim auto expenses, if your vehicle is under $6,000, you have an option to either do mileage or actual expenses. And I usually recommend mileage, and you have to decide what's best for you because some people do spend a lot of money on their car. But for the most part, you're probably going to spend more money on mileage than you do with repairs and gas. So I have an example about just the gas. So let's say that you fill up your gas tank for $75, and when you fill up, that usually gives you about 300 miles. So if the mileage rate is 67 cents per mile, and then that's $300 times 67 cents. So a full tank of gas will get you a deduction of $201. So just imagine if that's 10,000 miles for the year. You know what I'm saying? So you're definitely going to benefit more, most likely, if you do the mileage deduction. And you have to choose that at the first year of using that vehicle because you can't go back and forth with how you choose to do that. So if you're thinking your first year, oh, I have a lot of expenses this year and I want to do that with actual, you have to continue to do actual, and so that might go against you. So definitely talk with a tax professional. I could definitely help you with that, and before you decide on which one you want to do. And you can use different apps to help you maintain your mileage. So I like Mile IQ and QuickBooks Online. You just put the app on your phone and it will track everywhere that you go. And then when you have some time, you could just sit back and go through your miles and it'll tell you where you went, and you can categorize them by personal or business. And then at the end of the year, you'll have an accurate count of how many miles you spent exactly for business. Now, if you only use the car for business, then you could just use your starting mileage and your ending mileage, and that'll work just fine. And if your vehicle is over 6,000 pounds, you don't have an option. You have to use the actual expenses and depreciation. So business use of home. So most people qualify for this, and this is something else that is a deduction, and it will not go beyond taxes due. So sometimes if you have a business and you use it for at home, the more that you spend on the business, if your expenses are at a net loss, if you have a net loss, the business use of the home is not going to benefit you, because this will help reduce, but it's not going to add to the negative, if that makes any sense. So this is criteria for how you can use the business use of the home. Is part of your home used in connection with business? Yes. Are you using it as a part of your home as an employee? If not, then you can use business. So just use this chart and you can see if you qualify for the deduction or not. If you have any questions about it, I could definitely help you with that. And these are some of the, hold on. These are some of the industries that I have worked with over time. And as you can see, I have a broad range of businesses that I work for. So it's several different industries. And currently I'm trying to focus on car dealerships, but I am accepting clients of any industry. And I would love to sit with you and do a free tax preparation consultation with you. So go ahead and book your appointment with me at pbsllc.pro/calendar page. And thank you for joining me today.